This video was made in partnership with the Daily Upside, a daily newsletter that reached out to sponsor me. I said I'd take a look at it because I wanted to get paid. Now I actually read this religiously. Visit the link in the description to learn more. A lot of the time I find myself getting wrapped up in things that aren't really that important. I'm sure all of you guys can relate to this feeling. Your job's not going well, you're failing your classes, you pushed on a pull handle for way too long in front of 6 people to the point where someone actually stopped what they were doing so they could come over and try to help you. Or other, oddly specific things that didn't happen to me in the past week. Now, these things happen to everybody. They happen to everybody. They happen to everybody. And they can live rent-free in your head if you let them. However, sometimes all it takes is a little perspective to recognize how good you really have it. And what I've found is that there's no better way to give yourself this perspective than by looking at crippling financial losses on Wallstreetbets. That's a philosophical spin I tried to put on this. In reality, I just like looking at these losses because it's fun. And it teaches you exactly what not to do. So today we're going to take a stroll down memory lane, looking at some of the most violent financial losses you have ever seen or will ever see. Oh my god, they're so bad. I'm guessing if you already watch my channel, you're starting to become kind of desensitized to massive financial losses. After all, it's just numbers on a screen that don't actually translate to anything in real life. Right? But if you're new to this whole investing, stock market kind of thing, this is probably going to be somewhat jarring. The losses we're about to look at are the quickest and most violent way any average person could ever lose money. It would actually be harder to go to the bank, get hundreds of thousands of dollars in cash, drench it in gasoline, and light it on fire. Like, that would take longer. So prepare yourself physically and mentally, because we're about to visit the graveyard of Wallstreetbets. The graveyard of the internet. But before that, we have to learn about the architecture of financial losses. Not all are created equal. I'm guessing a lot of you newcomers are probably going to be asking, how? How could you lose so much fucking money? Also, you're probably going to notice throughout this video that there are some patterns that are remarkably consistent throughout the entire video. Let's break this down. Nature has the golden ratio, the Fibonacci sequence, a sequence of numbers that strangely seems to show itself everywhere in the universe. Flower petals, shells, hurricanes, even galaxies seem to follow the same pattern. In financial losses, we see a few different patterns. Let's start out here. This is just a classic Wallstreetbets loss chart and a pattern we'll most likely see often throughout the rest of this video. It's actually funny how perfectly this represents investor psychology. I feel like I can tell you the exact thought process at all of these points. So what happened here? Let's use technical analysis artwork technology to try to uncover the truth. We can break this down into a few psychological phases. Let's start here at the beginning, when you first started investing. Maybe you read The Intelligent Investor, maybe you figured you should start throwing some money into an index fund. The reason doesn't really matter. What matters is that this is the first and last time you'll make money doing this. You've probably got a good diversified portfolio of blue chip companies that are heavily correlated with the S&P. You were so innocent. Now, what you're seeing right here, I like to call experimenting with the dark arts. This little spike right here, it's so funny how accurate this is. This is you discovering options. A brief view into a world that you had no idea was even possible. You can never return from this place. Pandora's box is open. Despite you feeling like you're learning so much, I promise you this is the end of your financial career. I like to call this period volatility exposure therapy. The market doesn't want to scare you away with big volatility. You'll disable options forever. Instead, it's going to let you test the waters a little bit, just enough to push you into the next phase. Degenerative risk-taking behavior. That one's pretty self-explanatory. And it leads us into the next phase. Jacked to the tits. You're convinced you are Warren Buffett. You have a money printer in your pocket. This phase usually lasts a few hours to days, and it leads us to the final phase, imminent destruction. Now, despite what you might think, imminent destruction doesn't happen here. Imminent destruction happens here, the moment you enable options trading in Robinhood. This is incredibly important to understand. So that's a brief overview of the most common financial loss chart. Understanding each of the phases can help us determine the psychology involved with losing hundreds of thousands of dollars. Now let's get into the most violent financial losses you will ever see. But quickly, to introduce the sponsor of today's video, The Daily Upside, a daily newsletter written by a team of former investment bankers, scholars, and journalists. Some of you might not know this, but a lot of the headlines you see in whatever finance app you use are generated by AI. And for any of you that were scared AI was going to take over the world, all it takes is one look at these headlines to realize we're not going to be seeing Terminator anytime soon. Most media outlets don't give an accurate representation of what's really going on in the market, and are sometimes blatantly wrong. And most of the content that is written by real humans is littered with bias or was written by career journalists with limited experience. Instead, The Daily Upside is written by industry professionals that actually give you relevant and accurate information. It's crisp, concise, and perfectly witty. They also don't take themselves too seriously, so you don't need to worry about starting off your day with headache-inducing financial jargon. Just quality, straight-to-the-point information with the right amount of spice. You can subscribe to The Daily Upside with the link down in the description. It's completely free, and you can always unsubscribe if you don't enjoy it. Now back to your regularly scheduled financial losses. Let's begin here. We've got another classic $45,000 loss. It's okay. You know, 45 grand is like that awkward amount where it's not really enough to justify buying anything cool or balling out, so it's almost more convenient to just not have it. That was obviously the thought process here as well. I don't really know what to use it for, so I'm just gonna lose all of it. As you can see, we've got the increase in volatility from options trading here, followed by the implosion. Classic. The silver lining with this is that if you felt comfortable gambling with short-term options, I'm guessing your lifestyle isn't taking a massive hit from this. Let's all hope. In any case, I commend thee. Okay, so there's a lot to break down here. We can see, already, $50,000 has evaporated. This was another GameStop implosion. The guy bought $90,000 of out-of-the-money calls expiring in 2 days. For those of you who may not fully understand what that means, I joke a lot about donating money to Wall Street on this channel. That's usually a joke, but this is actually like taking $90,000 out of your bank account, calling Goldman Sachs on the phone, and saying, hey, I want to wire you $90,000. And the funny thing is, that would actually take longer. This is a perfect example of why it's incredibly important to recognize that buying a call isn't the exact same as going long on the stock, and you need to understand implied volatility before you mess around with options. This was posted on March 11th, right at the peak of the second GameStop rally. The problem is that a giant rally like this increases the implied volatility of GameStop options so much that the options market is literally pricing in 100% moves in GameStop's share price. This is a good lesson. It shows us that before putting $90,000 into something, reading even one Investopedia article might save you a lot of money. Alright, an 18-year-old making 100 grand with AMC calls, then losing it all. Pretty classic story of Wallstreetbets degeneracy. What is $100,000 really? That's like free college tuition. The exit strategy. The thing all of us know we should have but never actually end up using. With this, we really once again have to beg the question, what would have been an acceptable return? If 10xing your money in a matter of weeks wasn't, is there any return that would have ever made you sell? Just something to keep in mind. This is so funny. Apparently at Fidelity, if you lose thousands of dollars, they send you a nice letter checking in to see if what you're doing is, consistent with your investment objectives. And to see if you're still alive. At Fidelity, we believe it's important for investors to periodically review their investment strategies and trading activity to ensure that each is consistent with their investment objective, financial circumstances, and risk tolerance. This is why we wanted to make you aware that last month, 63 trades were executed in your above referenced account, and the overall equity value of your account decreased by $438,000. See, at least you get an actual certificate from Fidelity. Please consider reviewing your account statements and trade confirmations to determine whether this activity is still consistent with your investment objectives. This activity? What, losing $500,000? Yeah, I can't say that was consistent with my investment objectives. Thanks for looking out for me though. See, there you go, always a silver lining. So, with this one I'm just curious, what were you buying this year? $400,000 to exactly zero. Impressive. This was posted in November of 2020, which means the S&P returned over 50% in the 6 months prior to this. Like, looking at this, it's actually remarkable how consistently you were able to lose money in a time when the S&P returned so much. Won't go back to Robinhood. I think this guy brings up a good point. I'm just gonna take a wild guess here and say there is probably something fundamentally wrong with your trading strategy. I guess the lesson here is to never bet against the Fed. Painful $500,000 loss. You know, Warren Buffett said something about how consolidation builds wealth and diversification protects it. I don't know if this is what he was talking about. American Airlines, not a bad play for the pandemic recovery. Probably a situation where you want to buy shares though. Seeing this is just painful. How much money do you need? Going into this with out of the money options just seems like a recipe for disaster. And, of course, the clowning ensues in the comments below. Love to see it. So, what was the thought process here? I'm genuinely interested to know. Obviously, you guys can see the situation. Another GameStop millionaire turned $35,000 into $5 million. This is a perfect example of if it's good enough to screenshot, it's good enough to sell. I think this comment just sums it up pretty well. If you turn $35,000 into $5 million and don't sell, there is no amount of money you could have made that would ever make you sell. $5 million invested into an index fund returns an average of over $300,000 per year on autopilot. I mean, fuck, throw that money into AAA corporate bonds with a 2% yield and collect $100,000 per year for the rest of your life. Do anything. Anything except what you did. Is there anything we can take away from this? Well, from everything I've seen, it seems like no matter how much money you have, it will never be enough, especially when it's just numbers on a screen. What's one common trait between all of these losses? Greed. Icarus flying too close to the sun or whatever. If it's good enough to screenshot, it's good enough to sell. An ancient piece of Wallstreetbets wisdom that we all need to remember sometimes. Create a solid exit plan with all of your trades and stick to it. Or just buy index funds and actually make money. But where's the fun in that?